Good afternoon and welcome to this web conference with Movinn in relation to the company's Q2 report for 2023. I'm joined here today by CEO Patrick Blok, and my name is Johan Larsson, and I will be your moderator for today. I work as an analyst at Västra Hamnen Corporate Finance. We will, as usual, start with a presentation from the company, and after which we'll follow a small Q&A where I will ask questions of my own, and you listening can ask questions by yourselves, and I will try to bring them forward to Patrick. Before I hand over to you, I would just like to remind everyone that this session is being recorded, and the recording will be available on our YouTube page and on Movinn's homepage. So with that said, I give the word to you, Patrick.
Thank you for the introduction. Thank you for hosting this, and thank you for everyone listening in on our H1 report. I can see myself here. That's impractical. Sorry about that. All right, I'll get to it. It's been a quarter again of kind of the goods and the bads. To be completely frank, we are delivering decent top line growth still, a bit lower than what we want to do, but still decent top line growth. However, we are experiencing some issues with our bottom line performance, which is not as expected, and obviously not something that we are super happy with. But out of the general highlights, we've realized a top line growth of 21% compared to the same period last year. We've added some units in Sweden and none in Denmark. This is in line with our strategy, our sourcing strategy going forward. Those of you who have been listening earlier will remember that last year we had a very steep growth year measured in units. We added 140 plus units in 2 different countries and in 5 different cities. And doing that sort of incremental unit growth in smaller numbers is, we believe it's too inefficient. It's tearing a lot on the working capital. It's tricky to manage your procurement properly, and you're kind of exposing yourselves to more costs before the new units can generate revenue. So there's a lot of this is very deliberate that we then set out and said from now on out we want to do larger bulk growth hikes instead of this smaller incremental unit growth. We're still going to do it in a country like Sweden, in markets and in properties where we're already present. But in Denmark, we want to do bigger bulks in one go instead of that incremental stuff. So last year, even though we did a big growth, there was too much tear on bottom line margins last year, and that was why we the plan was to change the growth strategy for this year on the existing portfolio, and to kind of harvest the fruits of some of the growth that we did last year, where we for sure overperformed. So yeah, it's in line with the new sourcing strategy. I'll come back to that later on. Another fairly good highlight is that we have Sweden has more or less approached its break-even point. So yeah, 8-9 months down the line from operations, we are at the break-even level in June. That's a positive one. It means that the operations is sustaining itself, of course, and then it's easier to build on that platform instead of having continued substantial cash burn from the operations. We did an EBITDA in the Danish operations of 1.669. It's a margin of 4.3. It's well below our expectations. So we're unhappy with that. This is again, it's also down from the same period last year where we did 11.8. Again, those of you who've been listening in for a while knows that Q1 is historically a bit weak, so it's not the best performing quarter. And Q2 is then the quarter where stuff starts to pick up. So Q2 has not been in line with the expectations, like Q1 was not totally in line with expectations. So the bottom line stuff is something we are super focused on right now. It's annoying us, and we are kind of have all eyes on that. So managing our cost base being strategic about the portfolio, and again increasing revenues and sales in primarily the secondary markets. Copenhagen, Malmö, and Lund is going really well. Our secondary markets in Denmark are underperforming, so that's why we have a strict focus on it right now. So yeah, the group structure unchanged from last time. We have a Danish subsidiary, we have the parent company, which holds the most of the activity. We have the Swedish company subsidiary, which is in commercial operations, and then we have the German company where everything is set up and ready to go. All the legal framework has been completed, all the IP rights and stuff like that has been secured. So there's no commercial activity in Germany yet, but we still continue to have these sorts of negotiations with landlords on potential projects, and I'll elaborate a bit on that later on as well. The financial highlights, we show them in a segmented way so people can keep track of what's what and where where the revenue is being generated and how the cost base is evolving across the different markets. And you can see that on group level we're up by 21% on top line, but our cost base has also increased more than we would have liked. So that's something, yeah, we're working on. You can see we're realizing a negative EBIT, which wasn't part of the plan either. So we have some work to do on the bottom line metrics for sure. Sweden has been doing an EBITDA from operations of negative 500. That's throughout the 6 months, and as I'll show in a bit, June was the break-even month. So that's a positive, all things considered. The balance sheet is more or less stable. We have increased our some credit facilities to be stronger and have more kind of free cash available. Other than that, nothing major has changed there. We have incurred a negative cash flow from operations in Denmark, which is that is actually the consolidated numbers. We don't do that like country by country. So that is consolidated figures of negative 416. I'll jump to this because here you can see the more detailed cash flow statement. In here we both show, last year we show this period, and then we have isolated the Q2 numbers to give you an idea of how Q2 has evolved on a separate note. And what you see is that the free cash flow from H1 last year was way better operational than it is now. That is due to the underperformance in general on bottom line metrics for sure, and we also have some working capital allotments. That's mainly our inventory. We have a lot of operational assets in stock, also kind of more than what we wanted to have, but that's kind of the downside of doing that sort of incremental growth. You have to buy in large numbers, and it's not always that you can deploy that capital into apartments efficiently, so you will have something sitting in stock. So that's the main reason for that. That being said, you can see in Q2, if you look at the isolated figures, you can see that our cash flow from operation is positive in comparison to H1, so we've improved that in Q2, but totally working on getting that way up. Again, if you look at Q1 2022, the cash flow from operations was 3.5, so we have some work to do on that. That's for sure. And kind of tying a bow around all that, us doing the very steep kind of growth, the heavy investments in throughout 2022. The idea of this year was to get some very big projects in the pipeline, and then in the interim period you could kind of generate these free cash flows because you were not growing aggressively, you were not investing aggressively in increments, and you were not tearing on your margins. But we've had some demand issues in our secondary margins, which has been tearing on the overall picture. which is unexpected, and it's a shame. The key ratios, again, it's on a group level. We show it on a group level on the Danish operations and on the Swedish operations, so you can get an idea of how the different markets are performing separately. EBITDA in Denmark on 4.3, down from 11.8 last year. On group level, it's 2.8, so that's even a bigger. You can say that, you know, on a group level, it's more accepted, because of course doing new markets and doing growth across borders, that will have a tear, and that will have a negative impact on your bottom line figures and metrics. But we were definitely expecting the Danish operations to be more of a lighthouse, so to say, that could deliver these sorts of metrics that we know they can do. We have reported it earlier, so yeah, it's subpar for sure here in H1. And trickling all the way down, the return on invested capital is negative 2.6. Last year it was 8.7, so that's also a deterioration. The cash conversion ratio has deteriorated. The equity weight ratio is down a bit due to the incurred kind of loss, bottom line loss. Our quick ratio is still fine. We need to keep it above 1, that's for sure. And so that's within kind of the working capital requirements that we employ in the company. So that's still all right. Our cost of debt is down. That's of course positive. We are servicing a lot of debt, repaying debt. We've done some deals with our creditors, our banks, where we have a lower interest rate than we had last year. So that's a positive for sure. But yeah, the operational data, again, not this massive unit growth that we did last year. You can see last year we added 83 units to the portfolio, and we were still able to perform at 11.8 in EBITDA and etc. So the plan for this quarter was to not have that incremental growth. If you look at 83 units last year, that's what, 12, 13 a month if you take it linearly. If you didn't have that, the expectation was that you know, the engine and existing engine would just generate substantially improved margins, etc. That has not been the case. It is something we can fix for sure. It's we know exactly what's wrong. We have some demand drops in the secondary markets. We need to up that again, and then we'll be. So it is something that we know exactly where to look and where to keep it up. The revenue per unit is also one of the kind of important value drivers that we guide on, because it'll give you an idea of overall performance. It'll also give you a forecasting tool that you can use. There's improvement on that, on the revenue per unit, and that's of course positive. But the natural question then is, how come that is not, you know, affected or visible on the bottom line? And the answer to that question is that when you do 83 unit jump the last 6 months last year, then you still measure the number of units you have, but you won't have the full revenue effect of those units. In this quarter, we've had a full revenue effect of all the units that we had in the pipeline. So that means that the full revenue effect gives you a positive outlook. It could be better. If you remember the value driver guidance, the span is between 180 and 225. So even if it is at 198,000 per unit per year, it can definitely be better. And the last one is the vacancy, and this is basically where the issue is. As you can see, we are reporting vacancy of 16.3, which is way above what we used to, and it's also up from 9.5 in the comparable period of last year. So this is where, you know, you have your variable cost kind of gnawing into your metrics. We were expecting for sure to be more efficient on vacancy, and this is the main reason for the H1 performance. The vacancy rates are higher than we know they normally are at, and where we like them to be at. So that is the focus, to get the vacancy back to normal levels. Unfortunately, this is also as a consequence of this kind of underperforming 6 months, we have to do a downwards adjustment to our guidance. And going into the year, we did a guidance, as you can see in the table above. We have been through it a couple of times, so I'm not going to go into huge detail on the original guidance. You can see it here, and then we have done an updated guidance so you can compare the two. And we are behind on revenue in Denmark. We're on target in Sweden, so that's fine. Sweden is unchanged. Germany is unchanged, but Denmark has been revisioned downwards, and this is of course disappointing to us and to everyone with an interest in Movinn. So yeah, we've been forced to do a downward adjustment on the expected revenue and on the subsequently kind of bottom line metrics as well. And the EBITDA has been downwards adjusted, and so has the EBIT. So it's been you know, the explanation is fairly simple. In the secondary markets in Denmark, we have Aarhus and Odense, which is the second and third tier city in the country. Normally extremely stable markets, especially Odense. It has been extremely stable throughout COVID, for example. We didn't experience any volatility in Odense at all. But we've been hit with some correlation in our client portfolio that we haven't been good enough on detecting. And a lot of the clients have been international clients, so very big household names, and they've been on some projects in the city. Some of the projects have been just completed on schedule, and then, you know, everybody's happy. Thank you for now. We'll see you another time. And some of some big infrastructure projects has been cancelled, which means that we've just seen a drop in demand on the segments that we've normally been servicing and the clients we've normally been servicing. And you know, looking back, we haven't been strong enough in our local presence and we haven't been skilled enough to use, you know, the time to get a better local foothold in a city like Odense, for example. So we are kind of solving that now. We've gotten some good kind of local clients in, very big local companies in the portfolio, sports clubs. We are playing the insurance segment a bit more than normally. We're not that complacent, just sitting around and waiting for the phone to ring, which we've been accustomed to over the last, I don't know, 4 years in the city. So yeah, it's just been bad sales work. We should have done this. We should have done all this footwork when the demand was super stable, so we would be ready for when the international companies, for whatever reason, cease to have a massive demand in the city. So yeah, that's the main reason, and that's what we are focusing on correcting. The current product portfolio is the same. We have the same products in place like we had in H1 and ever since we more or less started doing these quarterly reporting. The service department or corporate housing product is still the main segment. It's generating 93% of the total revenue. Co-living continues to grow and is now delivering a share of 6.1%. And collective yo-yo, which is the furniture rental product, has also grown and is delivering 1% of the overall share. In this situation where we have where we need to put the focus in the core kind of market or core product. We're not running around trying to create new revenue streams or figuring out how to do more products. The idea is extremely good because these products we have in place, they represent a lot of synergy effects. The furniture rentals is a good way for us to manage our inventory. But right now the core focus is on the core business and just to get that demand up to where it used to be. And when that's done, we can then start to further develop other stuff. But we're not doing any, we're not throwing ourselves into any new fancy ideas on the product portfolio in the short term. The client concentration. Normally this just says strategic outlook. Now I've added the future learnings, and that this is coming out of what I just explained regarding Odense a minute ago. We have these, we can measure these client concentrations, and as long as we have a good diversification of clients, we're not that worried, because that means that the market is efficient. It means that we're not relying on single clients. And all the time we've been reporting this client concentration, we've always had, you know, brackets below 5% or whatever, so we didn't have any huge exposure towards a few number of clients. And then the downside of the Odense one was that at face value, looking at the client portfolio, it was different clients, and again some household names and some subcontractors and stuff like that, but a lot of them were kind of correlated on underlying projects. So there was some data center activity, for example. There was a lot of correlation in what looked like a very diversified client portfolio. And similarly in some of the infrastructure projects in the city, working on the harbor, working on the tram, working on there was some a heat plant and things like that. They were then, those projects were simply just completed and put into operations. So we got hit by some unforeseen correlation in that, and that is definitely something we've learned the hard way and taking with us from this kind of half year. This is a super simple slide. It was just to show the June figures for Sweden broken down into top line to EBITDA, and you can see that we've realized the revenue of 672,000 Swedish, and we are losing 19 krona. So that is as close to the break-even point as it gets, which is of course positive. The Swedish organization is performing super well. Demand remains strong. Of course, we are not totally, we read the news, we monitor all the economies that we are operating in, and there is of course some shakiness in Sweden that you have to look at, and some macroeconomic circumstances that you have to kind of take seriously. So everybody's kind of playing the waiting game a bit in Sweden, including us. It's not that we have this massive thing, massive investment, massive risk undertaking in the super short run on the way. That's no secret. But it has to do with monitoring the general economy. We don't want any, if there's a recession, why add a ton of supply if demand will be weak. But again, let's look at the positives and the here's and nows, and the fact is that they are breaking even and doing a great job. Other than that, technology development, this is a slide you've seen before if you've listened in before, and it's the same. It remains like a massive strategic focus. The market is the general kind of market that we're in, the industry we're in. It's under constant change. There's a big internationalization happening, where bigger clients, they want bigger partners. So you can solve this in kind of, you can ride this wave in two ways. You can be extremely strong with your technology backbone, that will allow you to be an efficient partner even if you're not like a worldwide operator, and that will give you some relevance with the very, very big clients, international clients. or you can solve it by being worldwide, having a worldwide presence as an operator, and obviously we don't, so we have to do it with technology. And we are it's a constant push, but it's a good push, and we are doing some super nice stuff. We've kind of lifted the veil on this a bit earlier on. We want to figure out a way to commercialize this technology that we have. It's in my opinion really strong, and right now is only kind of servicing us in-house and making us a sleek operator and an efficient kind of sales platform, but it has the potential to do more. This slide is also not new. It is our furniture brand. Again, looking at it from afar, it's like, why do you have a furniture brand? That sounds crazy, but there's actually a lot of careful thought put into this. The furniture has been designed in a specific way to be durable and replaceable. It's also a way to differentiate yourselves from all the other kind of pups in the litter, and it's also a way to of course decrease your needs for investments. It goes without saying, if you can buy and design stuff in-house and buy it directly from a factory, you don't have any middle links, so you kind of own the concept, and you don't have to pay wholesalers, retailers, whatever, so you can keep your investments lower than you would if you didn't do that. So I encourage everyone to kind of give this a crack. It's also a good way to differentiate yourself when you're talking to the landlords. If you have a very strong FF&E concept, it will be a positive standing out factor when you are in negotiations with landlords. So this is in all matters a very good idea for us. The downside is that the kind of coming out of the thing I mentioned with the working capital is that you need to buy a container full of sofas. So you get 40 sofas in the warehouse, and you only need the 5 in the short run, and what do you do with the rest? So we're working on creating this universe and this living platform that is kind of part of the Movinn family, where people can see and basically also shop the experience. So if they've been in an apartment, they like the furniture, we get that a lot. Where can I get the sofa? Where can I get the coffee table? And when we tell them that it is an in-house brand, they're kind of vague a bit, but we're in the process of creating this super nice platform where our clients can buy the experience that they're looking in. So trying to create an experience that is more of a lifestyle thing and less functional thing, where you just need an apartment, with 4 walls and 6 knives and 6 spoons and that sort of thing. It is tying a story together, which we believe is stronger and setting us apart. After the quarter or the 6 months ended, we recently broke the news that we signed a massive project, and of course this is this sourcing strategy in action, so to say. So it's fairly big. It's not like we have 35,000 square meters in the portfolio, I guess, I think. So this has 4,700. So measured in square meters, it's not that massive, but measured in units, which is 94, is obviously a big jump. And it's in Copenhagen, so it's in a key existing market that we know very well already. The Copenhagen market is extremely stable, demand is high, so it makes a lot of sense to kind of do this substantial growth in a market where you're already knows your way around, and know the clients and know the supply very well. So this is a very good example on the sourcing strategy we've employed. It is it's a lot of units under the same roof, so easy to manage. In the basement there'll be a wellness center, so there's like saunas and cold baths, gym, that sort of thing. In the ground floor there'll be a communal area where people can kind of hang out a bit. It's not a massive area because it's inefficient to have too much square meter that cannot generate rent, but people can hang out. They can sit at a desk if they need to finish up some work on a Friday afternoon, etc. So it's creating this kind of holistic holistic product where you can kind of, you know, manage your health. You can work, you can leave for work, you can come home, you can go to the gym, you can kind of take care of all that sort of stuff that we believe is good for everybody, and you can do that under one roof. It's also being developed with a lot of sustainability at heart. So there's a lot of the certificates is going to be extremely strong. There's going to be solar panels and all that thing incorporated into the building. So it's going to be very good for us and kind of in line with our ESG goals. So it's going to be great. The downside is it has to be built, so that it'll take some time before they come in. But when they do, we believe it to be an extremely efficient way to grow. It's also less capital intensive to do it like this, because when you do this sort of deal, there's more negotiation parameters than there is on doing a small 10 unit, 20 unit thing. When you're doing this sort of thing, there's way more kind of valves you can adjust. The value drivers from a property developer angle is different than the value drivers from an operator's angle. So if you understand that mechanism, which we do, then you can create some very good terms, which will give you a good launch, which should give you a good start to this product or to this type of product. So we're happy with this. This is a good milestone, and the developer is extremely pro, and so is all the advisors. It's been very good. The current markets unchanged. You know them already if you've listened in before. Copenhagen, Aarhus, Odense, Malmö, and Lund. We are, you can see the 36 pipeline has taken a big jump to 96 units. We're adding a couple in Copenhagen. It's in a property where we're already present, so it makes good sense to add more in that. And then we're handing some back in Aarhus. And I also mentioned it in my CEO statement when we did the full report, that a grip, you know, when you see markets that are underperforming, we have the option to restructure them. So if we see units that are structurally not performing the numbers that we want to see, we can let them go, and then we can deploy the operating equipment. We can deploy that in units that will deliver the numbers we want them to. So for the time being, we are letting go of 4 in Aarhus, which is not dramatic, but it was in a location that we could see was underperforming, and there's no need to kind of drag that stuff along with you. It's a grip. We can also do more in Aarhus if we want. If you have a market that's structurally underperforming, the issue with Aarhus is that there's a lot of supply right now, a lot of apartments, a lot of added competition. So we have the majority of our properties is in some very good locations there, so we will always be able to compete on that. But having these secondary locations that we've taken in because the market was on the up last year, we can easily let them go again, and that is a grip we can take and probably will take if we don't see improvement. And a similar mechanism can be employed in Odense. We can then take the operating equipment and put it into 10 Copenhagen units, which will then deliver the margin. So that's a flexibility in our existing portfolio that is working in our favor, and that is something that we can do. The next markets in focus also unchanged: Stockholm, Gothenburg, Hamburg, and Berlin. They are obviously close to home. They are close to, again, us being in Sweden is very you know, it's a low-hanging fruit to do more in Sweden when you're already operating and have an organization and that sort of thing. So of course we want to do that, but you can see that the pipeline looks a bit meager, to say the least. And you know, if you've read the news in Sweden and in Germany, you'll know that, you know, in Sweden the property market is a bit shaky at the moment, to say the least, and that also puts a kind of a hold on new development. And if you wanna, we had a case in Stockholm, for example. We're still kind of looking at it and see if we can swing it around. But if the appetite for development is not great, then, you know, new developments are going to be scarce. That is obviously going to put a make it more difficult to secure a similar project like the one I just showed you in the cities. If the development appetite and the property development stuff, if bank financing and those sorts of things are kind of freezing a bit up, it will hold it will hold, you know, the pace of how fast we can grow there, because we need someone with a project that we can operate for them. That's obvious. In Germany, we see a similar thing. It's not that well documented because the Danish, you know, the Swedish news and the Danish news is kind of more entangled into each other. But in Germany, you have kind of a similar situation. You have inflation levels that are higher than they should be. Financing costs are going up. There are some developers that might have overreached a bit. So there's also a bit of a vacuum in Germany. And to give you a very specific example, we've negotiated a deal in Hamburg. We loved it. It was a 40-unit building. We were meant to kind of get it signed off. Everything was done and dusted, but the developer then needed more time to get it all his stuff in order. So instead of just signing it and progressing and they could start building, then now it's, you know, there's some exclusivity stuff in place and some first right of refusal in place, but nobody's ready to kind of push the button. So it's been frustrating that we see that some of these deals are falling flat, not in our end and not because of what we're doing, but because of the underlying development is unable to secure financing or whatever, or the construction costs are too high, or what do I know. So we're still in some good talks, and it's not like completely shut off, but we can feel that it is kind of it's going slower than what we wanted. These kind of macro circumstances. The roadmap is the same as always been. Domestic unit growth has to be maintained at a 20% CAGR. It will be, but differently than the incremental stuff. So now we've secured the one coming in 25 with roughly 100 units. That's the sort of thing we want to do going forward. It's going to be way more profitable to do it like that, and it's gonna give us these big growth jumps. The new markets is another one. It's another one part of the strategy we had in 2021. We did the 2 markets last year in Sweden. Yes, we want to do more in Sweden. Maybe it won't be as linear as we kind of hoped it to be because of different circumstances. Also kind of what I just explained, but it's still the plan to kind of crack on. But of course, you need to have a solid base. You need to have the right products. You don't want to, or the right projects. You don't want to jump into stuff you don't like just because you feel under pressure to deliver these sorts of targets. So we are going to be picky, and if it means that we will be behind on this, then so be it. We are not going to jump into stuff that we don't feel comfortable with in the long run. Launching new products also part of the roadmap. As I mentioned earlier, we're kind of looking at our IT to see if we can figure out a way to commercialize that. So that's not something that will need any investment or stuff like that for us. We have the in-house capabilities to do this, so that's going to be probably still going to be a focus. Securing the pipeline, that's basically also what we did with the big one in Copenhagen. There's different ways to do that. There's obviously M&A activity. There's different approaches. So we're looking into all sorts of things, but again, not rushing into stuff. Not just because we feel pressure to, we need to secure the pipeline. No, that's basically not what we're doing. We're more interested in getting the right products at the right pricing, so we know that the risk is going to be managed. And that kind of comes down to the value drivers, the growth, the new markets, the unit metrics, the EBITDA margin above 15%, the return above 18%, the vacancy below 10%. And tracking progress on that in H1 is obviously not a pretty sight. The growth is still going to be there, but it's not going to be linear. The revenue per unit is in the green. That's within the guided figure, but the rest of them are underperforming. So that's what's keeping me at my toes. It is to get the red ones back in the green, and that's all I'm doing more or less these days, besides negotiating and new deals and looking at opportunities. So that was it. Thank you for your time. I'm happy to take questions. Let me know what you think, and I'll wing it as always.
Thank you for that, Patrick. Before I start with my question, I just want to tell everyone that who's listening that you can also write your own questions in the question field to your right. So I just want to start off by asking a bit of a general question, because in the last couple of quarters you have been talking a bit about the macroeconomic climate and the rising costs and stuff. And I was just wondering if there's ever been plans or talks about raising the rents of your apartments, or if that's more of a last case scenario.
No, it's definitely a tool in the box, and we have been doing it for sure. So we are constantly adjusting rates. If it's a long-term contract, you can only do it once a year, but it can kind of follow the cost pressure that we're under. If it falls in between, you're not able to do it, but then you can. So there's going to be some stickiness to that fact, but you can do it ongoingly. And it is something we have done systematically to kind of keep that inflationary pressure kind of at bay. That being said, you can't do that forever. Luckily in Denmark, we can see the inflation numbers that they're going down rapidly because you can't just keep raising prices. It'll diminish bargaining power, purchase power in the consumer and for the consumers or the client. So we can do it, but it's not possible just to indefinitely just raise your prices if you look at it from like a kind of commercial angle. But it is a tool, and we are doing it constantly.
Yeah, you mentioned that the biggest issue of this quarter has been the couple of quarters before this as well has been the increasing vacancy rates, and I guess that the raising rents would have a negative effect on this. But how will you work in the future towards decreasing these vacancy rates?
We see, Copenhagen is stable and is being, the trooper here. We have a massive portfolio, all that stuff. I think right now we have one available apartment in Copenhagen, so it's extremely good. Obviously there is the seasonality and all that thing, and so the culprit is in the secondary Danish markets, and we've done different stuff already. We have employed a local sales rep who can be. We've always had that thing where we would manage everything from Copenhagen. And there are these kind of regional teasing going on, a Copenhagener and a Jutlander. They have their little regional things, and we kind of love each other and hate each other at the same time. So I guess you have a similar thing in Sweden. So we have hired a local rep who is kind of managing the west of Denmark. He started working here with us in May 1. We've added a couple of part-timers to our marketing team, so we can up that. There's some we've been. I wouldn't say complacent because it's an ugly word, but when you have markets that are just, you don't have to do anything. It's just the demand is just falling into your lap. It's a tricky decision to kind of say, okay, now let's everything is coming to us. We're not doing really anything. We're just have a super good quality and the right pricing. And the clients are just coming without us doing anything. It's a tricky decision to say, okay, let's go and hire a 500K a year sales rep, or 450 or whatever the cost is. And so for me, looking at the bottom line and all that sort of thing, I've not been focusing on that. I've been focusing on, okay, where can we improve on margins, and how can we and when is it time to do the German launch, or when can we branch into Stockholm? I've been more in the strategic watchtower, so to say, not the last 6 months, but the year before that. So basically upping the local presence. I kind of mentioned it in my presentation. We've had too much reliance on big international companies coming from outside of the city or the cities, being here for a year or 2 years or whatever, and then leaving again. They're not leaving because they're unhappy. They're leaving because their project is over. So and that creates a dilemma, because we're totally booked. Let's say in Odense, we've been more or less fully booked the last 3 years. And so even if you go out to locals and say, hey guys, please look at what we're doing. We think you would be happy to use our service. We wouldn't have anything to offer them. They wouldn't get any apartments. So it's a tricky balance. But now we're working a lot on the local markets and kind of revitalizing our old kind of relationships with them. And we've not been good enough at doing that in parallel. We've not been fast enough to do it when because we could see, so yeah, we hired a local guy, revamping local, committing to local football clubs and things like that, and get the local networks way stronger than we had early on. That's the trick right now.
Yeah, well, I kind of guess that answers my question of how you will offset the declining demand in Aarhus and Odense. Or do you think you will still see declining demand in general there with these projects, or do you think more projects will come and they refill your vacant position?
Yeah, there is again, it's there's a big local client base that remains more or less untouched for us. And again, it almost feels criminal to say out loud, but it's been because we've just not had anything we haven't had any vacancy, so we wouldn't have anything to offer them anyway. And then you become and then you are like, okay, let's focus on the growth and the Copenhagen growth and getting new clients into Copenhagen, and you kind of take your eye off the local pole in that scenario. But there is a very big local client base. We've gotten a big client in Odense who is going to use us for their onboarding programs when they bring in new people. They've already started booking, so we have high hopes for that. We have been committing ourselves to the local football club in the first tier league, and we'll be attending some networking things and stuff like that. But we should have done this 6 months ago or 12 months ago instead of now, and that's on me. In the end, it's my responsibility. I should have. It's not that I haven't said it to my team, but I should probably have been more I should probably have been more of a spearhead on that instead of leaving it up to guys that were busy elsewhere. So there's a big local untapped presence that we can tap into, and that's what we are doing now. So yeah, that's the gist.
Okay, moving on. I noticed in your report that your long-term debt had increased with roughly 3 million. I was wondering if you could tell me something about that.
Yeah, we just upped our credit facilities to have more firepower in the future. We're also servicing a lot of debt in on the other hand. So it's like we're servicing some more expensive debt to bring down the interest rate, and then we get some cheaper debt from the bank. And so that's why. So we're upping it, and then we're also servicing debt elsewhere. And it's just a matter of having the right firepower at hand. The proper working capital, whatever we kind of need to sustain whatever we're doing in the long run. So that's it was a calculated thing.
Okay, in your securing the pipeline strategy, you mentioned small talks of M&A, and I was wondering if you could tell me more about what you mean by this, because this is something I haven't read before, I think, in the reports.
No, it's looking at it's just looking at all options available. There are deals to be structured that not necessarily is what you would consider classic M&A that will, because M&A activity is extremely expensive it's an expensive way to grow. So it's not like we're going to do, but there is opportunities out there. There's companies who are restructuring, who don't want to, there's opportunities. I can't really go into details about it, but there is some opportunities available. You could that would allow you to enter a market maybe in a way, but the classic M&A activity is not something that we are pursuing at the moment. But we are in talks with potential, different models that kind of has that M&A vibe to it, for sure. But it is still the organic way, the going alone strategy that we've always employed. That's still the same. So it's not like you don't expect an M&A to be around the corner, but it's just part of, you know, the opportunistic approach to the markets. If we can find a local established player that wants to do something together in whatever way, we will give it a look. But there's nothing in the short term kind of horizon.
I understand. Okay, moving on to the new markets of Stockholm, Gothenburg, and Germany. I was just wondering a bit of the strategy there, because you speak of a big, larger bulks of 30-40 units. Will it be similar to your new lease agreement, where you basically build a property, or will it be more as it has been in the past, where you secure a lot of units at the same time and then launch? If you understand my question.
Excellent. Yeah, I know it's a perfect question, and the answer is that in the perfect world, we would love to do a development together with a real estate player of whatever shape or form. And let's say they have an old, worn-out building, and it can be revamped or get repurposed into our concept, so we can get a 50-unit whatever commercial property in a good location. That is my take on the Swedish approach. And the reason for this is there's a lot of reasons for it. It's kind of, again, realizing that it's more. I'm not saying that we're not going to add some units, but the best case scenario, or the scenario we want to kind of deliver on, is to do a similar thing as the one we just did in Copenhagen, where it doesn't have to be 100 units, it can easily be 50 or 40, but it has to be, in my opinion, in the same building with a strong concept, and you come in the early stage of the development, and you have something with the right kind of commercial structure. So that's what I want to do in Sweden. And in Germany it's the same. The good thing about Germany is there's still some different there's a lot of different there's a lot of activity still in Germany, so we get to see a lot of different stuff, and okay, we like that, we don't like that, let's go on and let's proceed. So yeah, but it's basically the same. Let's say from 30-ish to 100 units under one roof in the same building, that in a good location. That is, for me, that's the only way we can grow this efficiently and scale it properly in the future. The other model is capital intensive. It's tearing on margins. It's killing the free cash flow. It's killing the people running around trying to do everything, and me whipping them around and say, or the Swedish director whipping them around and saying, well, we need to get done. So so yeah, that is going to be the future for us.
I understand. Okay, we're gonna finish this with a question from the audience, which reads, how have you managed to deliver a strong revenue per unit at the same time as vacancy rates are higher than normal of 16.3% on Danish units? Is the raised prices you mentioned affecting the revenue per unit in a positive way, or are there other reasons as well?
Yeah, it's a great question. I kind of touched on it, but I'm very happy that there was this support question built into it, because of course there's the time value of money is a factor as well. So for example, in Denmark we've raised rents with let's say 4% roughly, and the 4% then runs into the 2023 numbers, and the bracket for 2021 when we did this guidance is still at the low end, so to say. So we probably should think about inflation, kind of regulate that going forward. So that's a very good point to be made. And the other explanation is that we get the full revenue effect of the entire portfolio. So normally when we would report revenue per unit, let's say we had 83, and let's say that 20 of them came in May, and we are measuring a 6-month period, then the 20 will only have a 1-month effect, but we're measuring on a full 6-month effect, if you know what I mean. So we don't have that kind of relapse in our full period effect on the units, And that's also part of the explanation why we're performing better per unit, but not good enough. So we can definitely do more, as you can see from the correlation between the revenue per unit and the vacancy. If the vacancy goes below the 10s again, the revenue per unit would be in the high end of the guiding bracket, and that should deliver some substantial profit. Yeah, so yeah, I hope that answered it. But a very good point on the inflation stuff, because of course our costs, there's also some of it that are inflation kind of what do you call it, exposed to inflation. The rents we pay the landlord. We've had some of the electricity costs and that sort of thing that has risen as well. So so that kind of goes hand in hand, and they're kind of eliminating each other. But we should probably do some sort of a time value or of money or inflation thing in that guidance bracket to keep it more comparable. I will do that.
Well, thank you very much for that, Patrick. I'm out of questions, and there haven't come in any more questions from the audience. So thank you very much for this presentation, and we'll see each other in the next quarter.
Thank you so much, guys. Take it easy.